In the early 1920s, the United States government secretly transferred control of strategic oil reserves to private companies. These were not ordinary oil fields. They were naval petroleum reserves created to supply fuel for the U.S. Navy. After World War I, petroleum had become a critical military resource. To protect national security, the government designated specific reserves for naval use. Two of the most important were located at Teapot Dome in Wyoming and Elk Hills in California. Control of these reserves was intended to remain tightly regulated by the federal government. But in 1921, administrative authority over the reserves was transferred to the Department of the Interior. Soon afterward, private oil companies received exclusive leasing rights to these government fields. The agreements appeared lawful on paper. Official contracts were signed and filed through normal administrative procedures. However, the leases had not been offered through public bidding. Behind the agreements were secret financial arrangements. Millions of dollars were quietly transferred to Interior Secretary Albert Fall. The payments were described as personal loans. Investigators later determined the deals were part of a government oil lease scam built on bribery and political access. The scandal would become one of the most serious corruption cases in early 20th century American government. In the early 20th century, petroleum became a strategic military resource. Naval planners increasingly recognized that future fleets would depend on oil rather than coal. Oil-powered ships could travel faster, operate more efficiently, and refuel more quickly than coal-burning vessels. The transition required a reliable long-term supply of fuel. Military planners began worrying about what would happen during wartime shortages. Private oil markets could fluctuate or become disrupted during conflict. To reduce this risk, the United States government began creating strategic petroleum reserves. These reserves were intended to remain untouched during normal commercial activity. Their purpose was national defense. In 1912, the federal government designated several oil fields as naval petroleum reserves. These fields were to be preserved for future military emergencies. The reserves would remain under federal control and would not be freely leased to private companies. One of the most important reserves was located in Wyoming. The field was known as Teapot Dome. It received its name from a rock formation resembling a teapot. Another major reserve was located in California at Elk Hills. Both sites contained significant petroleum deposits. Their potential production capacity made them valuable national assets. At the time, global oil demand was increasing rapidly. Industrial economies were expanding their reliance on petroleum. Military strategists viewed fuel access as a core strategic advantage. Control over oil supply could influence military readiness. For this reason, the Navy originally supervised the reserves. The Navy intended to preserve the fields until they were needed during a future conflict. Extraction would occur only under strict government control. Private companies were not supposed to gain exclusive access. The reserves represented insurance for national defense. For several years, this arrangement remained largely uncontested. The fields stayed mostly undeveloped. Oil companies understood that the reserves were protected government assets. But the political environment in Washington began to change after World War I. The federal government was entering a new political era. Administrative authority over resources could shift depending on political leadership. Control over valuable assets often followed changes in government structure. In 1921, a decision would alter how these strategic reserves were managed. Responsibility for the fields would move away from the Navy. Authority would instead be transferred to the Department of the Interior. That administrative change would later create the conditions for one of the most significant corruption scandals in American political history. Strategic assets require transparent oversight. In March 1921, Warren G. Harding assumed the presidency of the United States. His administration promised stability after the political tensions of World War I. The new government also brought significant changes in federal leadership. One of the key appointments was Albert B. Fall. Fall was selected to serve as Secretary of the Interior. The Interior Department managed federal lands and natural resources. This authority included large areas of mineral and oil reserves. Fall had previously served as a U.S. Senator from New Mexico. He was known in Washington as a supporter of private resource development. Many Western politicians believed federal lands should be opened to commercial use. This perspective aligned with oil companies seeking access to new reserves. Soon after taking office, Fall began advocating for greater Interior Department control over federal oil resources. At the time, naval petroleum reserves were supervised by the U.S. Navy. The Navy's policy emphasized long-term preservation. Oil companies had limited direct access to these protected fields. Fall argued that Interior could manage the reserves more efficiently. He also suggested that portions of the fields could support national production. The proposal required transferring authority away from the Navy. In May 1921, the Harding administration approved the change. Control of the naval petroleum reserves moved from the Navy Department to the Department of Interior. The transfer appeared administrative rather than controversial. Official documentation authorized Interior to manage the reserves. The change did not initially attract significant public attention. Government departments often exchanged responsibilities through executive decisions. However, the shift placed extremely valuable oil fields under a new decision-maker. Secretary Fall now controlled access to major petroleum reserves. This authority included the fields at Teapot Dome in Wyoming and Elk Hills in California. The Interior Department could determine how the resources would be used. It could also decide whether portions of the reserves would be leased. This new authority created significant opportunity. Oil companies closely monitored developments in Washington. Private firms understood that access to government reserves could be extremely profitable. Large petroleum companies had the capital and equipment required to extract oil quickly. If leases were approved, those companies would gain major production advantages. At this stage, no public leasing process had been announced. The reserves remained government property, but administrative control had quietly shifted. Authority over strategic resources had moved into a different political environment. Control defines opportunity. After the Department of the Interior gained control of the naval petroleum reserves in 1921, Secretary Albert Fall held direct authority over leasing decisions. The reserves at Teapot Dome in Wyoming and Elk Hills in California remained officially designated for naval use. However, Fall argued that controlled private extraction could prevent oil from being lost to nearby drilling operations. Oil fields could sometimes drain across property boundaries. If neighboring private wells extracted petroleum, reserves located under government land could slowly migrate. Fall presented this argument as a technical concern about resource conservation. Using this reasoning, he began negotiating leasing agreements with private oil companies. The agreements were not announced publicly in advance. No competitive bidding process was organized. Instead, specific companies were quietly selected for negotiations. One of the companies involved was Mammoth Oil, controlled by oil executive Harry F. Sinclair. Another was Pan American Petroleum, led by Edward L. Doheny. Both companies were major players in the American oil industry. In 1921 and 1922, Interior approved leasing arrangements granting these firms access to the naval reserves. Sinclair's company received the Teapot Dome lease in Wyoming. Doheny's company received access to the Elk Hills Reserve in California. The contracts allowed the companies to extract oil from government-controlled fields. Official documentation presented the leases as legitimate conservation agreements. Interior officials stated that the arrangements protected the reserves while allowing controlled production. On paper, the leases appeared consistent with administrative authority. However, the process raised several unusual questions. The agreements had been negotiated without public notice. Other oil companies were not invited to submit competing offers. There had been no open auction. This absence of competition meant the government had limited ability to evaluate the true market value of the leases. The companies receiving the contracts gained exclusive access to valuable petroleum resources. Because the reserves had been created for national defense, their private leasing attracted quiet concern within parts of the government. At first, these concerns remained internal. Most of the contracts remained out of public view. The official explanation focused on resource management. Interior argued that the agreements ensured responsible development. However, the secrecy surrounding the negotiations began to attract attention from a small number of observers. Some members of Congress began asking how the leases had been awarded. They wanted to understand why strategic reserves had been transferred to private companies without competition. Those questions would soon expand into a broader investigation. Opacity creates leverage. As leasing agreements moved forward, attention gradually turned toward the personal finances of Interior Secretary Albert Fall. Fall had recently experienced significant financial difficulties. His New Mexico ranch required large investments to remain operational. Public records indicated that Fall had limited liquid assets at the time he entered office. However, shortly after approving the oil leases, his financial position improved dramatically. Large sums of money began appearing in connection with his personal accounts. The payments were not recorded as compensation from the federal government. Instead, they were described as private financial transactions. One of the most significant transfers came from Edward L. Doheny. Doheny was the head of Pan American Petroleum. His company had received the lease for the Elk Hills Naval Reserve. In late 1921, Doheny arranged a payment of $100,000 to Fall. The money was delivered in cash. Doheny later described the payment as a personal loan. According to his account, the loan was intended to assist Fall with financial obligations. The arrangement was not publicly disclosed at the time. No formal loan documentation was immediately filed in government records. Another set of financial benefits was connected to Harry F. Sinclair. Sinclair controlled Mammoth Oil, the company that received the Teapot Dome lease. Evidence later showed that Fall received additional financial advantages connected to Sinclair's interests. These included livestock purchases, property improvements, and other indirect payments. Each transaction was presented as a private arrangement rather than an official payment. However, the timing of the transfers raised serious questions. The money moved shortly after the oil leases were approved. Fall continued to oversee the contracts during the same period. In official explanations, the transactions were described as legitimate loans between acquaintances, but investigators would later examine whether the payments were connected to government decisions. The distinction between a personal loan and a bribe depends on intent and context. At first, these financial relationships remained largely unknown outside a small circle. Government contracts continued to operate under the authority of the Interior Department. Oil companies began preparing extraction operations at the leased reserves. However, unusual financial movements rarely remain hidden indefinitely. Records, witnesses, and financial trails eventually surface. When investigators began reviewing the transactions, the structure of the payments became central to the scandal. Money disguised is still influence. By 1922, rumors about the naval oil leases had begun circulating in Washington. Some members of Congress questioned how the contracts had been awarded. The lack of public bidding attracted particular attention. Under normal circumstances, valuable government resources were expected to be leased through competitive processes. Competitive bidding allowed the government to compare offers and maximize public revenue. In the case of the naval reserves, that process had not occurred. Instead, the leases had been granted through direct negotiations with selected companies. The unusual structure of the agreements prompted inquiries within the Senate. One of the most persistent investigators was Senator Thomas J. Walsh of Montana. Walsh began reviewing documentation related to the leasing decisions. He requested records from the Department of the Interior. The early stages of the inquiry focused on administrative procedure. Senators wanted to determine why the reserves had been transferred to Interior control. They also wanted to understand the legal justification for the private leases. At first, the information provided by the department appeared incomplete. Key financial records were not immediately available. This lack of documentation increased suspicion among investigators. Meanwhile, journalists began reporting on the developing questions in Congress. Newspapers across the United States started covering the story. Public interest grew as more details about the secret leases emerged. Articles described how strategic naval reserves had been transferred to private oil companies. Readers learned that no public auction had been held. The coverage raised broader concerns about government transparency. As attention increased, additional witnesses were called before Senate committees. Officials from the Interior Department were asked to explain the leasing decisions. Oil company representatives were also questioned. Early testimony focused on technical explanations about resource management. However, the Senate inquiry gradually expanded beyond administrative procedure. Investigators began examining financial relationships connected to the leases. They wanted to determine whether private payments had influenced government decisions. The investigation required reviewing bank records, contracts, and personal financial statements. Each new document added pieces to the emerging picture. What initially appeared to be a policy question began to resemble a corruption inquiry. The press continued publishing developments from the hearings. Public scrutiny intensified as the investigation progressed. Institutional power invites institutional scrutiny. By 1923, the Senate investigation into the naval oil leases had expanded into a formal inquiry. The hearings were conducted by the Senate Committee on Public Lands. Senator Thomas J. Walsh continued leading much of the investigative effort. The committee began examining documents connected to the Teapot Dome and Elk Hills leases. Witnesses from government agencies and oil companies were called to testify. The early sessions focused on administrative decisions within the Department of the Interior. Officials explained how the reserves had been transferred from Navy control in 1921. They also described the legal authority used to approve the private leases. At first, many of the explanations appeared procedural. However, investigators continued requesting additional financial records. The committee asked for information about the personal finances of Albert Fall. This request proved significant. Bank records and financial statements began revealing unusual transactions. Investigators discovered that Fall had received large sums of money shortly after approving the leases. One of the most important payments involved Edward L. Doheny. Evidence showed that Doheny had provided Fall with $100,000 in cash in late 1921. The payment had been described as a personal loan. However, the timing raised questions about its connection to the Elk Hills lease. Additional financial benefits connected to Harry F. Sinclair were also examined. These included indirect payments and financial advantages provided to Fall. As these details emerged, the hearings gained national attention. Newspapers across the country reported daily updates from the Senate investigation. Public interest increased as the financial relationships became clearer. Committee members questioned Fall directly about the payments. Fall maintained that the money had been legitimate private loans. He denied that the funds had influenced government decisions. However, investigators focused on the sequence of events. The payments had occurred soon after the oil leases were granted. This timing created a strong appearance of financial influence. Legal experts began analyzing whether the transactions constituted bribery. The hearings also revealed that the leasing agreements had been negotiated without competitive bidding. This combination of secrecy and financial transfers intensified scrutiny. Political pressure increased as the investigation continued through 1923 and into 1924. The scandal began affecting the reputation of the Harding administration. Government officials faced growing demands for accountability. What began as a procedural inquiry had evolved into a major corruption investigation. Secrecy collapses under documentation. By the mid-1920s, the Senate investigation had produced a substantial body of evidence. Financial records, testimony, and contracts were now part of the public record. The central question became whether the payments to Albert Fall constituted bribery. Federal prosecutors began reviewing the findings of the Senate hearings. The Department of Justice evaluated whether criminal charges were warranted. Attention focused primarily on Fall's acceptance of money connected to the oil leases. Investigators examined the timing of the $100,000 payment from Edward L. Doheny. They also reviewed financial advantages linked to Harry F. Sinclair. Legal authorities considered whether the payments were legitimate loans or improper inducements. The distinction would determine whether criminal statutes had been violated. After several years of investigation, formal charges were eventually filed. Albert Fall was indicted for accepting bribes related to the naval oil leases. The charges alleged that the financial payments were connected directly to government decisions. The case moved into the federal court system. Evidence presented during the trial included financial records and witness testimony. Prosecutors argued that the payments were intended to influence Fall's leasing decisions. The defense maintained that the money had been private loans between acquaintances. The legal proceedings attracted significant national attention. By this stage, the Teapot Dome scandal had already become widely known across the country. Many Americans followed the case through newspaper coverage. In 1929, a federal court reached its decision. Albert Fall was convicted of bribery. The ruling established that the payments were connected to his official actions as Secretary of the Interior. The conviction carried an unprecedented consequence. Fall became the first cabinet-level official in United States history to be sentenced to prison. He served time at a federal penitentiary. The case set an important legal precedent for the accountability of senior government officials. Holding a cabinet position did not shield an individual from criminal prosecution. The conviction demonstrated that federal courts could pursue corruption cases involving high-ranking officials. It also reinforced the principle that public office carries legal responsibility. The outcome of the case became a defining moment in the history of American political scandals. Investigators, prosecutors, and courts had followed financial evidence through multiple layers of authority. The process took several years, but eventually produced a criminal judgment. The case showed how corruption investigations can move from congressional hearings to federal courtrooms. Legal accountability had reached the highest levels of government. By the time the bribery conviction was secured, the political consequences of the Teapot Dome scandal had already reshaped public perception of the Harding administration. President Warren G. Harding had taken office in March 1921, promising a return to stability after World War I. His administration promoted the idea of a government run by competent administrators and business leaders. Many cabinet officials were selected from established political and commercial circles. For a period, the administration maintained broad public support. However, several controversies began emerging during Harding's presidency. Teapot Dome eventually became the most damaging of these scandals. Although Harding died in August 1923 before the full investigation concluded, the leasing decisions had occurred during his administration. As Senate hearings expanded, public attention increasingly focused on the broader culture within the government. Newspapers questioned how a cabinet secretary had been able to negotiate secret resource leases. Editorials examined the relationship between political authority and private business interests. The scandal did not necessarily prove that the president had been personally involved. However, it raised concerns about oversight within the executive branch. The existence of large financial transfers connected to official decisions suggested weaknesses in administrative control. Political opponents used the scandal to criticize the administration's management of public resources. Congressional debates increasingly referenced Teapot Dome as an example of federal corruption. Public confidence in national leadership began to decline. Trust in government institutions can shift rapidly when corruption cases become visible. The investigation also encouraged broader discussion about the relationship between natural resources and political power. Strategic assets such as oil reserves carried significant economic value. Control over those resources could influence both markets and political relationships. When access to such assets appeared linked to private payments, public concern intensified. The scandal remained in headlines throughout the mid-1920s. Each new development reinforced the perception that government systems required stronger oversight. Although the legal proceedings focused on individual accountability, the political impact extended far beyond one official. Administrations are judged not only by policies, but also by the conduct of those who hold authority within them. Even when leaders are not directly implicated, scandals connected to their governments can shape historical legacy. The Harding administration became permanently associated with the Teapot Dome case. Political historians later treated the scandal as a major turning point in discussions about government ethics. Public trust, once weakened, can take years to rebuild. Scandals outlive administrations. As the criminal investigation progressed, attention also turned toward the oil companies that had received the leases. The contracts granted to Mammoth Oil and Pan American Petroleum had provided access to valuable government reserves. When the Senate investigation exposed the financial relationships connected to the leases, the legal status of those agreements came under scrutiny. Federal authorities began reviewing whether the contracts had been obtained through improper influence. If bribery had been involved, the agreements themselves could be invalidated. The government initiated legal action to challenge the leases. One of the central cases focused on the Teapot Dome lease granted to Harry F. Sinclair's Mammoth Oil Company. Federal lawyers argued that the contract had been secured through corrupt arrangements with Secretary Albert Fall. The dispute eventually reached the United States Supreme Court. In 1927, the court reviewed the legality of the leasing agreement. After examining the evidence, the court ruled that the contract had been improperly obtained. The Teapot Dome lease was declared invalid. Control of the Wyoming Reserve returned to the federal government. A similar legal process unfolded concerning the Elk Hills Reserve in California. The lease granted to Edward L. Donaghy's company also faced legal challenges. Courts examined the circumstances surrounding the agreement and the payments connected to Fall. Although Donaghy himself was later acquitted in a related criminal case, the controversy surrounding the lease remained significant. Legal authorities concluded that the government had the right to reclaim the reserve. The Elk Hills Agreement was also overturned. These rulings reinforced an important legal principle. Government contracts obtained through corruption cannot remain valid. The courts emphasized that public resources must be protected from private manipulation. For the oil companies involved, the scandal carried lasting consequences. Even where criminal liability was not established, the reputational damage was substantial. Public scrutiny of corporate relationships with government officials increased sharply. The events also demonstrated that corporate access to political power carries significant legal and financial risk. Companies operating in regulated industries depend heavily on government decisions. When those relationships become entangled with corruption investigations, the business consequences can be severe. The Teapot Dome case became a warning about the long-term risks of political favoritism. Government favoritism carries risk. The Teapot Dome scandal did not end with the court rulings against the oil leases. The investigation exposed weaknesses in how the federal government managed public resources. It also revealed how administrative decisions could be made without sufficient transparency. In response, lawmakers and policy experts began examining how similar abuses could be prevented in the future. The management of public lands and natural resources became a subject of renewed scrutiny. Congress reviewed procedures for leasing government assets to private companies. Officials recognized that the absence of competitive bidding had played a major role in the scandal. Without open competition, there had been little opportunity to evaluate the fairness of the agreements. Competitive processes allow multiple companies to submit offers. This creates transparency and helps determine the true value of public resources. After the scandal, policymakers emphasized the need for clearer leasing procedures. Public auctions and open bidding became more widely recognized as safeguards against favoritism. Administrative oversight also received greater attention. Congressional committees increased their monitoring of executive branch decisions involving federal lands. Documentation requirements for government contracts were strengthened, and financial disclosure expectations for senior officials gradually expanded in later decades. The scandal also encouraged closer examination of conflicts of interest within government positions. Officials responsible for allocating public resources could face strong incentives from private industry. The Teapot Dome case demonstrated how financial influence could distort those decisions. Strengthening oversight mechanisms became an important institutional response. Investigative journalism also gained renewed recognition as an accountability tool. Newspapers had played a significant role in bringing public attention to the scandal. Public awareness often acts as an additional layer of oversight in democratic systems. The episode became a case study in political ethics. Universities, historians, and legal scholars later examined the scandal as an example of structural corruption. The lessons extended beyond the oil industry. Any government system that manages valuable assets can face similar risks. Transparent procedures reduce the likelihood that individual officials can secretly allocate public resources. Institutional checks help ensure that decisions are reviewed by multiple actors. These mechanisms are designed to protect public trust in government administration. The reforms that followed Teapot Dome reflected a broader effort to strengthen accountability within federal institutions. Oversight expands after failure. The Teapot Dome scandal became one of the most studied corruption cases in American political history. It involved strategic national resources, senior government authority, and large private corporations. At its center was control over oil reserves originally created for national defense. These reserves had been designated to protect the fuel supply of the United States Navy. The resources were not intended for private extraction during normal conditions. However, administrative authority over the reserves shifted in 1921. Control moved from the Navy Department to the Department of the Interior. This administrative change placed leasing authority under Interior Secretary Albert Fall. Soon afterward, private companies received exclusive access to the reserves. The agreements were negotiated without public bidding. Official contracts were issued through administrative channels. On paper, the arrangements appeared legally authorized. However, the process lacked transparency and competition. Behind the leasing decisions were private financial transactions. Large payments were delivered to the cabinet secretary responsible for approving the contracts. Those payments were presented as personal loans. Investigators later determined that the financial transfers were linked to the leasing decisions. The exposure of these payments triggered a Senate investigation beginning in 1922. Over time, financial records, testimony, and documentation revealed the structure of the arrangements. The investigation expanded into one of the most significant corruption inquiries of the era. Eventually, the case moved from congressional hearings into the federal court system. In 1929, Albert Fall was convicted of accepting bribes connected to the oil leases. He became the first cabinet member in United States history to serve time in prison. The courts also invalidated the oil leases obtained by the companies involved. Control of the reserves returned to the federal government. The scandal damaged political reputations and weakened public trust in government institutions. It also demonstrated how control over strategic assets can attract private influence. When valuable public resources are managed through opaque processes, opportunities for corruption increase. Secret agreements reduce external oversight. Financial influence can become disguised through personal transactions. Investigations eventually expose these structures when documentation emerges. The Teapot Dome case illustrates a recurring pattern in political corruption. Strategic assets create economic incentives. Authority concentrated in a small number of officials increases vulnerability. Financial transfers are often disguised through indirect arrangements. Exposure usually begins when administrative decisions attract scrutiny. Investigations follow the financial trail. Legal accountability may take years to develop, but the structural pattern becomes visible over time. The scandal remains a reference point for understanding corruption in resource management. When public resources are privatized in secrecy, corruption becomes inevitable.